To all my listeners, whether you're a gold bug or you're concerned about inflation and protecting your capital, you need to check out my brand new conversation with Dan Ferris on the Stansberry Investor Hour podcast out now. You can easily access the episode by clicking the link in this video description box. Hope to see you there. Hi, welcome back to Stansberry Research. Joining me today is Greg Foss. He's a former hedge fund manager and trader, now a risk manager. Greg, welcome to our show here.
Thanks so much for having me. It's a pleasure to be here.
I kind of followed your career for a long time. I know you've been very vocal on the topic of Bitcoin, on the Freedom Convoy. We're going to talk about all that today. But first, no shortage of geopolitical tensions, Russia and Ukraine front stage and center. And as we're speaking, we're seeing the moves in gold. We're seeing the movements in Bitcoin. Do you think that there can be any thesis drawn from this as people are pointing and showing that perhaps gold is the best safe haven play here?
Oh, well, okay. So that's a great intro because yes, there's always conclusions that can be drawn. To be clear, I own Bitcoin and I own gold and I own silver and I own other hard assets. But what you are seeing is the traditional old money versus new money gravitating to the traditional risk asset in the event of global unrest, and that's gold. The short term is that Bitcoin is still treated as a risk asset. So when equities fall, Bitcoin will fall. You can even argue that Bitcoin leads them down, given that Bitcoin trades 24/7 and Bitcoin was down hard last night, and then the equities and futures opened down this morning. But my experience is this: in my experience, 30 years in the financial markets, it takes a long time for the markets to learn the true characteristics of an asset. Bitcoin's only 13 years old. Most money managers do not understand the most beautiful characteristics of Bitcoin, which I, as a credit manager, view that Bitcoin is actually a short credit position, meaning when you own Bitcoin, you have a short position on sovereign debt. And I love that, because when you are short credit, you are long volatility, you are long insurance. And it takes a while for the market to understand it. I believe there are times when Bitcoin does perform as an insurance policy. There are other times when the big money and the hedge fund guys will short it as a correlation trade against other hedge fund or other risk assets. So you can draw conclusions in the short term. The long term is this: gold is fine, Bitcoin is way better. But I own both. As a risk manager, I don't go all in on any one trade. But let's be honest, for the last 10 years, gold has been a bit of a non-performer. And it's finally performing, and I'm happy about that because I have a position in gold, a long position. I have a very good friend who I think is one of the best risk managers, publicly traded risk managers out there. His name is Lawrence Lepard, and he is a gold manager who is moving money into Bitcoin because he feels the same way as I do, that in the long run, Bitcoin is the better horse at the race.
Yeah, and Lawrence is a good friend of our show here. So, Greg, I've seen previous podcasts where you've made very bold forecasts for Bitcoin, as high as 20 million, first getting to 2 million, but you wouldn't rule out 20 million. I mean, these are astronomical numbers. How do you make the case for that?
Okay, so, and it's quite simple. So I'm an engineer, Daniela. We talked earlier. I went to McGill University. I was an engineer, but then graduated into the financial engineering business. So everything I do is probabilities based. Everything I do is based on mathematics. And that's what's great about credit, because credit is all math, okay? Equities, you can call it math, but there's a lot of subjectivity to equities because, I see a company growing at this rate. Fixed income is exactly that. There's no growth in fixed income. It's a fixed contract. So credit is pure math, and that's why I'm very comfortable with credit as an engineer. Engineers are typically good at math. But here's how I get there. Very simply, look, the total global financial assets in the world are 900 trillion US dollars in today's dollars, okay? 900 trillion US dollars. That includes all global debt, not just government debt, global debt, bank debt, provincial debt, state debt, muni debt, structured debt. That's about 400 trillion. It includes all global equities. It includes all global currencies. It includes gold, which is 10 trillion, for a total, and it includes all global real estate, for a total value of $900 trillion. That's what I term as my total addressable market, because Bitcoin is a financial asset that, in my opinion, is going to eat the lunch of a lot of these other financial assets, in particular bonds. I've spent 30 years in bonds, and I can tell you with no degree of uncertainty, they are absolutely the worst investment you can possibly make for your money. And that's $400 trillion of this 900 trillion pie. Anyway, stick with me. $900 trillion. I believe that Bitcoin someday will become the reserve asset, global reserve asset. And when that happens, and it'll probably happen because a country like Russia wants to get paid for its oil in Bitcoin rather than in US dollars. Why? Well, Bitcoin is monetary energy. It requires proof of work. And natural resource energy for monetary energy makes a whole lot more sense in my mind than natural resource energy for worthless and debasing fiat dollars. As an engineer, I like the conservation of energy principle. I know Michael Saylor's a big fan of that too. So if that happens, is it crazy to think, again, if Bitcoin becomes the global reserve asset, is it crazy to think that Bitcoin gets 5% share of $900 trillion? Don't forget, right now, the global reserve asset is treasury bonds, US treasuries. If Bitcoin gets 5% of $900 trillion, that's $45 trillion. What's 45 trillion divided by 21 million fixed supply of Bitcoin? That's $2 million per Bitcoin. That's with a 5% market share. In today's dollars, what if it gets 20% market share? That's how you get extremely large numbers. So this is all I am saying. I'll start with a 5% target. It's not a limit, it's a target. And 5% of 900 trillion is 45 trillion. 45 trillion divided by 21 million is 2 million US dollars per Bitcoin in today's dollars. Put a probability on that. I say I do a probability distribution, or I can do a binary distribution. I don't want to lose your viewers too much, but let's do a very simple binary distribution. What if there's a 10% chance Bitcoin attains my price target in today's dollars and a 90% chance it goes to zero? The expected value of that binary distribution, meaning only one of two outcomes, is $200,000 per Bitcoin. Well, it's trading at 40,000. To make the math easy, 1/5 of where that probability distribution says it should trade. Now you can actually change the distribution as you like. What if you say, okay, it's a 50% chance it goes to zero, a 50% chance it goes to 2 million. Well, then all of a sudden that expected value is $1 million of Bitcoin in today's dollars. So Danielle, all I'm saying is you got to look at these. It's like going to the horse track and you've watched a horse train and you think this horse is one of the top horses in the race, but the racetrack is giving you a 100 to 1 odds that it'll win. And you're like, man, I think the odds of this guy winning is at least 1 in 10. You're supposed to put bets on that guy because the track is giving you odds that are in your favor. And it's the same with Bitcoin. It currently is trading in the markets at 1/50th, or sorry, it's currently trading in the market at a probability of it getting to $2 million of only 1/50th, right? A 2% chance. I'm taking those odds because I think the chances are it gets there. I'm not going to say over 50%, but certainly over 30%.
Fair enough. Fair enough. So let me ask you a few questions here. In what time frame could you see this happening?
Here's the great question. That's a great question. And this is what I always did when I was a trader. I'll give you a target, but not a time, or I'll give you a direction, but not a price target. So over time, number goes up, or my target is 2 million bucks of Bitcoin, open-ended. Could it happen quickly? Unlikely, but possibly. Could it happen in my lifetime? Yes.
But what about the angle or the aspect of coming regulation? You mentioned Russia.
Right.
They've stepped back from using the word ban, but there will be coming regulation in the crypto space.
Positive regulation, the way I read it. Did you read it differently?
I'm just talking regulation in general. I just want to get your thoughts on what you think regulation would mean for the space, coming regulation.
Okay, great question. So regulation is good to the extent that it makes big money comfortable investing in that asset class, right? There's a huge amount of money that's just sitting on the sidelines right now that wants to get involved in digital assets in particular, or in general, and Bitcoin in particular. You saw the Fidelity research report on Bitcoin, I hope. And if you haven't, I suggest your readers go out and read that report. It's absolutely phenomenal. And Fidelity is one of the top 5 asset managers in the world. I promise you, when Fidelity gets involved in something, every single other asset manager in the world is looking at it as well, in order to be able to offer that product to their client or risk losing that client to Fidelity. It's just like high yield bonds in Canada. I started trading high yield bonds in Canada 25 years ago, and there was one account in Canada that bought junk bonds. Now every single account in Canada has a high yield bond sleeve, just because it makes sense. You're going to see the same thing happen with digital assets and Bitcoin, and regulation is positive for that.
I was going to ask you that. How far away are we from US banks actually using a Bitcoin as collateral?
It's a great question. It'll be a process, right? Some banks are currently examining it very closely. Other platforms do it already, and thereby are disintermediating the banks in the current here and now.
Short term, Greg. Okay.
Yeah.
Short term, though, because I've had other experts, technicians, call them whatever you want, coming on saying, okay, we might get to, hey, let's start with 100,000 Bitcoin.
Yeah.
Okay, because that's the kind of the first target.
That was the laser eyes.
Right.
That was all
right.
the laser
That was the
eyes.
laser eyes, right? Let's just, for purposes of the story, let's stick to 100,000.
Okay.
So they're saying before we were to get to that, we're going to have to retest, go back down. It's going to be this
all
winter.
True. Look, potentially, but nobody knows. And by the way, if you think it's going to go down and you're waiting to buy it, I see this all the time. You're too smart by a half. Just buy it on a disciplined basis each week. Get to your target weight, and your target weight has to be greater than 0. Why? Because in my 30 years, Daniela, this is the best asymmetric trade opportunity and investment opportunity I have ever seen. If you own 0, you are taking far more risk than if you have a proper portfolio allocation. And with all due respect to Peter Schiff, he is not a good risk manager because his allocation is 0. And how's that worked out for him so far?
Are there other opportunities? Cardano, Polkadot, Ethereum. What are your thoughts on those? Was it just Bitcoin?
I need you to understand that the reason I love Bitcoin so much is because I hate fiat currencies so much. Fiat currencies are programmed to debase. They're programmed to allow the global banking system to be able to lever themselves 25-1 and thereby consistently get into financial crises because they are so levered. And they're therefore backstopped by the governments. The governments being able to print money can bail out the financial system. Fiat money is programmed to debase. Bitcoin, on the other hand, is 21 million fixed supply, and it is programmed to conserve the value of your time and energy in today for consumption in the future. So as an engineer, I do not like fiat money, and Bitcoin is the solution. None of these other digital assets have the same characteristics of Bitcoin. So that's how I just prefer to comment on why I like Bitcoin, because of my distrust and distaste for fiat currencies. So we both mentioned we grew up in Montreal, right?
That's
so right. After I came back to Montreal from the States, I did a business degree in the US. I came back to Montreal. I worked for Royal Bank of Canada, Canada's largest financial institution, in 1988, Daniela. My first project working directly for the CFO was to evaluate the Royal Bank of Canada's Latin American debt portfolio, or defaulted loans. Lo and behold, Royal Bank of Canada, using a very simple calculation, was insolvent. Insolvent. Canada's largest bank had a negative book value of equity if you were to write down all their Latin American debt to the trading value of the loans, which was about 25 cents on the dollar. I couldn't believe it. I had gone through 6 years of schooling, and I come back and work at Canada's largest financial institution and realize that the Fiat is a Ponzi scheme. And now, Royal Bank of Canada wasn't alone. Every single other money center bank in New York and globally was in the same situation. And that's why Treasury Secretary Nicholas Brady had to introduce in the late 80s something called the Brady Plan. And it was a brilliant solution, but it was accounting gimmickry. They didn't have to mark their loans down to market because they had built a plan that it would be backed by US Treasury zero coupon bonds over a 30-year period. And it was just accounting gimmickry, and it was wise, and it was smart, and it rescued the financial system. But every single financial crisis I've gone through has been the result of fiat money.
So let's talk about flaws in the banking system, because you just kind of opened Pandora's box there. And I want to bring up a recent tweet of yours. All banks are 20 to 25 times leveraged to their equity base. You recently tweeted, this has not changed regardless of the removal of the Emergency Measures Act, War Measures Act in Canada. Banking is an extremely risky business that is made safe by implied government backstops. The bigger picture here, and if I could just add one note, you kind of were like front row and center involved in the Canadian crackdown, because you were identified as one of the 5 multi-signature key holders of the Bitcoin raised for the Freedom Convoy.
Yes.
So first, were your funds personally frozen? Were you?
At this point, I'd rather say no comment, because it's a difficult situation that I have had certain transactions frozen, but my funds as a whole, no. Okay,
so bigger picture,
yes.
though, okay, regardless of the Emergency Measures Act being now revoked, we were talking offline and saying, look, it revealed a huge crack and fragility, let's say, in the system, right? And for people.
Okay, so
would you not agree?
It did, and let me be clear how we got there. So firstly, I'll address my tweet. Everybody needs to understand that a bank has equity capital as their risk absorbing capital base, and they have depositors' money, both of which go into making a loan to a counterparty. For every $100 of loans, there's only $5 or $6 of equity approximately, and the other $94 is depositors' money and subordinated debt. So if that loan, which is worth 100 cents on the dollar, dips in value below 90 cents on the dollar, that loan in theory has blown through all of its risk absorbing equity, right? That's what happens when you're 25 times levered. 25 times is 25 times bigger deposit than your equity base. Banks are inherently risky because they are so highly levered. Now, no one understands that, and everyone says, well, I keep my money in the big 5 Canadian banks. And I'm not saying take your money out. I'm just saying understand the risks. And the risks are, when you are 25 times levered or 20 times levered, if the value of the loans you've made fall by more than 5 cents, you're in big trouble. And that happens regularly. That's the way credit markets work. So that's why I tweeted that.
Yeah.
And then my involvement with the Freedom Convoy. So firstly, I'm doubly vaxxed. I believe in freedom of choice and freedom of expression. And when the convoy started, I was approached together with my partners about putting together a fundraising platform that used Bitcoin rather than the GoFundMe that was in place prior. This was before the GoFundMe funds got frozen. Now, I want to be clear again. I am doubly vaxxed. This was not about anti-vax, anti-mandate for me. This was about freedom of choice and freedom of expression. I have a 21-year-old daughter. If she was trying to get pregnant, knock on wood, I don't think she is, but she's not married. So, but if she were, I would want her to have the choice whether she wanted to take the vaccine or not, if she was worried about the repercussions. So freedom of choice, that is my platform. I was one of the key holders that was assigned to a wallet that was collecting Bitcoin. The others are named out there. I'll just say there's some very famous Canadian Bitcoiners amongst them. And the reason that we were asked is to lend our legitimacy that this wallet address wouldn't up and run. We collect money from the Bitcoin community, and then all of a sudden the Bitcoin disappears. What happened was the GoFundMe got frozen, and all of a sudden this Bitcoin fund attracted over $1 million worth of Bitcoin. So it became substantial. We also knew, though, that given that I'm a Canadian and my other partners were Canadians, there was a danger that the authorities would view us as being a point of failure, if you will, and stop the funds from getting to the truckers. So we decided to remove ourselves. And we did so before it was deemed illegal. Never once did I participate in this when the government said that it was an illegal activity. I have not been involved. And I will just say this, that is why Bitcoin is beautiful. It's a decentralized platform. There's no central point of failure. Whereas in a bank, they can freeze your funds. I'm not going to say I agreed with them. I certainly don't agree with them freezing funds, but the bigger problem is when you freeze people's funds, they get nervous and they're like, what if I don't have access to my deposits, regardless of whether I was targeted or not?
Well, we saw what, the nervousness. I brought this up in another interview. I have friends who work at precious metals dealers, and gold sales were through the roof. Like people were panicking, watching this, thinking, I want to take some of my cash out of the bank and move it into other assets. Yes. So to that point, I want to go, and thank you for your clarification on that. Thank you for coming on the show and clarifying that. But I think it's interesting because you were once part of the system. You were, like you said, you worked for RBC, one of Canada's largest banks, and now quite critical of the banking system. But you're saying you wouldn't be completely out of the system.
No, I'm not critical. I'm honest. That's what I'm trying. Yeah. And this is what most people don't understand. Like a bank needs to lever itself that much because when you're making loans at, let's say, a spread of 2% over your cost of funds, no equity holder is going to lend money for a 2% return. What they have to do is lever that loan spread so that the return on their capital approaches equity types of returns. And that's the way the bank is set up.
So are you just saying, wake up, kind of get smart, you can have some cash in the bank?
I'd say this for a number of things. And you're such a good reporter. I love this. What I'm trying to say is understand that most people own dividend stocks, banks as dividend stocks. Don't rely on that as a pure dividend play. Understand how volatile the loan value of a bank is. When credit spreads widen globally, the value of the bank's portfolio falls precipitously. That's the way credit markets work. So understand that risk, and then also understand the risk that it's a central point of failure. If they wanted to freeze your funds, they can, like they just showed. And then I'm going to throw out another little nugget, Daniela. What happens when there's central bank digital currencies? What happens when they can cause you, with a flick of a switch, not to have access to your funds? That's a risk that I don't like because I'm a freedom guy. I like being free to spend my monetary energy as I desire.
I would like, Greg, your thoughts generally on U.S. equities, a sense of, we spoke about where you think the direction of Bitcoin, direction of gold.
Yeah.
What's the direction for U.S. equities here?
It all depends on credit markets, and credit markets are getting sick. And when the credit markets get sick, the equity markets die. Okay, every single crisis is led by the credit markets. 1988, Latin American debt. 1998, long-term capital management. Credit. Great financial crisis. Credit. Way credit. Oh, subprime is contained according to the Fed in 2007. That's a good one. Okay, 3 years later, great financial crisis, 2008, 2009. The world was ending. I was sitting in a risk chair. I can promise you, I thought every day going to work in that March, it was over. And things bottomed out because the Fed did what they had to do. Troubled Asset Relief Program, or TARP, bought all of these toxic securities off the balance sheets of banks. Where did it go? One level higher, right to the Fed. So 2019, 20, COVID, what caused the equity markets to puke so badly? It was the credit markets. There was no bid for any credit market or any credit product, including long-term treasuries. Did you know the bid offer spread in long-term treasuries? You could drive a truck through it. These are markets that usually trade like razor thin margins. These things had bid offer spreads that were crazy.
You mentioned 08, and it's interesting because I feel or fearful there may be parallels there, because, we could look back 08, right? And financial journalism, I speak as a financial journalist, failed to put all the pieces of the puzzle together. Like we saw.
It's not your fault, because you don't understand it. You're not taught it in school. This is not something they teach in school.
But I'm saying, financial journalism as a whole, right?
Okay.
We didn't piece together the whole puzzle that, hey, there's going to be something major that's going to break the system right here. Do you almost feel, because we were listening to the Fed chair at the time saying, everything's under control, no need to panic. Do you feel that the parallels are
absolutely
there today?
There are. You have a guy sitting in the most important risk chair in the world, Jerome Powell, and he's a lawyer. No disrespect to lawyers, but they're not that good at math. Okay. And he's never sat in a chair and understand how markets unravel very quickly due to a crisis in confidence. That's all credit is confidence in your counterparty. And when you lose confidence in your counterparty, the system breaks. And when the system breaks, equities go down hard. And we're in the same situation, or close to the same situation right now.
Greg, I want to bring it home with this, kind of the same way we started. We opened with gold versus Bitcoin. You've come out saying, look, hey, I own both. Now, obviously, your heart and soul are with Bitcoin. That's clear.
No, let's be careful. My heart and soul are not with Fiat. Is that fair?
Okay, not with fair enough. Yeah. Sorry. Pardon.
Pardon.
Pardon. Fair enough. But Greg, can I ask you to share, not reveal your portfolio structure here, but your gold holdings versus Bitcoin? How do you decide that?
So it's a dynamic process, because the prices change all the time. But I am, and this is advice I'm going to give to other people rather than myself. Okay, I'll divulge. I'm over 40% in Bitcoin of my entire net worth. Okay, I own 0 bonds. I own 40% Bitcoin and other hard assets. Yes, I own equities. Yes, I own gold. Yes, I own silver. And yes, I own real estate. I do not have any bonds. In fact, I am borrowing money from the banks right now because the rates are so low. That's what you're supposed to do. Okay. When rates are this low, you're supposed to borrow money. And by the way, I borrow $100 today and they want $100 back in 10 years. I will give them that $100 back in 10 years. Guess how much it's worth? I don't know, about 65 bucks. You're supposed to do that. You're supposed to borrow money. Now, I'm not telling people to go out and over lever themselves, but do not own bonds. That's all I can say. The second thing about this is it's a dynamic process. I've studied Bitcoin for 5 years. I've been looking for the solution to Fiat for over 30 years. When I finally found it, I didn't go all in, but I did go into Bitcoin in a pretty big way at under $1,000 bucks. And now it's 40 times my price. And guess what? I think it goes another 50 times higher. So it's the best asymmetric trade I've ever seen. My advice to your listeners is if you own zero, as I said before, you are taking immense risk that you are wrong. And that's in fact a more risky position than owning between 5 and 10% of your net worth in Bitcoin. Just my opinion, not financial advice.
I appreciate that. Last thought. I brought this up in another interview, but I was quoting Charles Munger, Warren Buffett's right-hand man, who basically was commenting on the dangers of inflation and how, when inflation gets out of control, this is how democracies die. He cited, that was the demise of the Roman Empire, etc. How concerned are you about the inflationary environment?
Whether it's inflation or deflation, the fiat dollar is going to zero. The US dollar will be the last fiat currency to fail. And there will be hundreds of currencies that fail before the US dollar fails, including your and my home country of Canada. Okay. The point is this: you need to develop a parallel system that protects people against the certainty of fiat debasement. The certainty of fiat debasement is only math, because our debt burden is so big, you need to print money to solve that equation, i.e., the economy can never grow fast enough to outgrow your current debt burden with the coupon on that debt. It's a mathematical equation that a grade 11 student can understand if we actually taught them that in school, but we don't. We don't want to expose the fiat Ponzi. So here's what I will say. Charlie Munger, with all due respect, also said he sees the US dollar going to zero over the next 100 years. And that is his thesis, or his hypothesis, I think. His working thesis. Hypothesis. The funniest thing is he also hates Bitcoin. Bitcoin is the solution. You're 94 years old. I understand you don't understand technology that well, but don't cost everybody who listens to you as some sort of guru the opportunity to participate in the best asymmetric trade opportunity I have ever seen in 30 years of managing risk. That's all I can say. I could be wrong, but if I'm right and you guys have no exposure, you've just lost a tremendous, you're Peter Schiff. You're Peter Schiff when you could have bought Bitcoin at $10 a Bitcoin, but he didn't. And if he had put 1% of his gold portfolio in Bitcoin, because the two things align, gold and Bitcoin. If he had put 1% of his portfolio in Bitcoin at $10, his entire portfolio would be up more than 10-fold from here. Except he's a very poor performing gold manager up until this point. So he's got a lot of Twitter followers who believe someday he's an ambulance chaser. He'll go around and say, oh, you see, I told you it fell from 69 down to 35. Hey, Peter, it also went from $10 up to 35. And this is unfortunate because that's what Larry Lepard understands. A really good risk manager who's also a gold bug versus a conflicted gold bug like Peter Schiff.
All right. Well, Peter's not here to comment.
I've been on. He will.
Yes,
admit,
I know.
He with Peter McCormick, and I have to say it because the guy is like a broken record. And by the way, I still like gold. The one thing on the positive basis, the thing that Peter Schiff and I agreed on, and this is his line: bonds are return-free risk. Quite a smart comment. Return-free risk, not risk-free return. Bonds are return-free risk. Credit that to Peter Schiff. We agree on that.
I appreciate your thoughts. And Charlie Munger's actually 98.
He's on the third standard deviation then. Okay. Congrats to him. He's done a lot of really good stuff. I just don't believe, well, let's turn it this way. He called Bitcoin rat poison. And I'll say he's right because fiat is the rat and Bitcoin is the poison. I don't diss gold. I am not telling you to sell your gold.
You know what? This show is great. We invite all sides. And I appreciate your thoughts. I appreciate your time. Greg, thank you for coming on.
I really appreciate it. I look forward to our next opportunity. Thank you.
Absolutely. And thank you all for watching. We'll have much more for you. So be sure to stay tuned to Stansberry Research. And don't forget to sign up for premier content at danielacambone.com. Thanks for watching.
opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.